My name is Stuart Chokreli. I lead our tax practice here in Oman and the UAE. Very pleased to have you join us this morning for this webinar as we come to 1 year since the introduction of VAT in Oman. This webinar is going to focus on the real estate sector and the recent guidance around that. Before I get into the agenda, what I'm going to do is just a bit of housekeeping. So questions, we'll have time at the end for questions. Please submit your questions in the Q&A tab on the right-hand side, and at the end of the webinar, I'll come back on and ask the presenters and the panel to answer the questions, and we'll try and get through all those questions if we have the time to do so. Also, after the webinar, there is a feedback survey, and please take a minute to complete the survey. We value your input, and it helps us with future webinars. Finally, this webinar will be recorded, and the recording will be shared with you after the webinar. With that, we'll just put up the agenda. I won't go through in details, but that's the agenda that we're going to be covering over the next 60 minutes. And I'll just introduce you quickly to the panel. So joining me is Abba. Abba is a partner based here in Muscat and leads the indirect tax practice of KPMG in Oman. She's also co-head of indirect tax for KPMG in the MESA region. She has more than 15 years of experience in indirect taxes, both in advisory and compliance, and she's advised clients on VAT, GST implementation across the region, Oman, UAE, Bahrain, and India. She also has experience in excise tax implementation in Oman and across the UAE. She can be joined by Sumit, who's an indirect tax associate also based here in Muscat. He has more than 11 years of experience working across Oman and India, particularly in the real estate sector with many clients in that industry. And obviously helping in the implementation as well as compliance and advisory matters. And then finally, Mohammed is joining us. He's an indirect tax analyst here, also based in the Muscat team. He has experience supporting many clients in Oman on VAT matters, and has built a good rapport and understanding of the issues dealing with the Oman tax authorities. So welcome panel, and with that, Abba, I will pass to you to begin the webinar, and thank you.
Stuart. Good morning, everyone. Thank you for joining. It's been a year since VAT was implemented in Oman. We went through a phased implementation, but even with the phased implementation, the last tranche of registrations was completed on the 1st April of 2022. There's obviously been some teething issues for taxpayers as well as the tax authority, but generally it's been a successful implementation, not just in terms of the reporting, but also in terms of the collections for the tax authority. So let's first begin with a quick overview of the guidance which has been issued by the tax authority in the last 1 year. The tax authority has invested a lot of time and effort to ensure that information, positions, clarifications are disseminated to taxpayers on a regular basis to help them improve their compliance status. So in terms of decisions, we largely see decisions being issued on registration. That was the monetary threshold for mandatory registrations as well as voluntary registrations. And then when we decided to go for a phased registration approach like Bahrain and Saudi, what would be the phasing over the 1 year? We also had decisions on zero rating of food items, and initially started with a list of about 90 products. The tax authority has kept an eye on public expectations and increased that list to 400 products, and then eventually a little over 500 products. And then there were decisions on zero rating of medicines and medical devices. In terms of guides, we've seen guides issued for sectors. Real estate is one of them. We've got oil and gas, transportation. We're having webinars even next week to cover some of them. And then there have been guides on procedural matters, registrations, returns, and a few generic schemes like the profit margin scheme or the capital asset scheme, reverse charge mechanism. So for all businesses that are subject to VAT, it would be worthwhile for you to look through the guides, because some of the guides that are sector specific obviously have clarifications for sectors relevant to you, but a lot of material in the other guides could also help establish some principles which may be relevant for your business. Other communication, there have been notices from the tax authority. One essential notice which would be relevant for this sector is on the treatment of supplies to government bodies, and there the tax authority acknowledges that government bodies, quasi-government bodies are required to be treated at par with any private body. So supplies made by a taxpayer to a government body will be subject to VAT just the same as they would be if they were made to a private sector entity. Having said that, earlier in this week when we discussed the oil and gas sector guide, there was obviously the carve out for supplies made in sovereign capacity when made by the government, not to the government. With that, we can move on to the next section, and I'll request Mohammed to kick this section off with an overview of key VAT positions. Mohammed, over to you.
Thank you, Abha. As you are aware, VAT in Oman is applicable on supplies at the standard rate of 5%, unless the supply is specifically exempted, zero rated, suspended, or outside the scope of Oman VAT. As a quick refresher here, in an exempt supply, the supplier can neither charge VAT from the customer nor recover any input VAT incurred on purchases used to make such supplies. On the other hand, in a zero-rated supply, the supplier can charge VAT from the customer at 0% and recover any input VAT incurred on purchases used to make such supplies, subject to normal input VAT recovery rules as well. Also, in an out-of-scope supply, the supplier cannot charge VAT from the customer, but depending on the nature of the transactions, may be able to recover input VAT incurred on purchase used to make such supplies. Finally, in a standard rated supply, the supplier can charge VAT from the customer at 5% and recover any input VAT incurred on purchases used to make such supplies, subject to normal input VAT recovery rules. So how does one assess whether a supply is standard rated, exempted, zero rated, suspended, out of scope for the purpose of Oman VAT? Well, that's based on the Oman VAT legislation. The Oman VAT legislation lists supplies that are exempted, zero rated, suspended, or outside the scope of Oman VAT. So this slide captures key supplies, which is exempted, zero rated, or outside the scope of Oman VAT. When effected within Oman, supplies exempt from VAT include financial services and local passenger transportation, healthcare services, and some supplies related to real estate. Also, when effected within Oman, zero-rated supplies include supply of crude oil, oil derivatives, and natural gas, supplies to customers in notified special zones, international transportation, specified food items, and medicines are also zero-rated under VAT. On the other hand, when effected outside Oman, goods and services exported from Oman qualify for zero rating. And finally, some supplies that are outside the scope of Oman VAT include supplies between members of a VAT group and transfer of business on ongoing concern. Please note, special treatment usually comes with conditions attached, so the exemptions and zero rating are subject to fulfillment of all conditions prescribed under the Oman VAT legislation. With that, I'll hand over the presentation. To Abha to discuss the key VAT positions in the real estate sector. Thank you.
Thanks, Mohammed. So now let's look at transaction level details. Let's look at what the guide clarifies beyond what the legislation already tells us. Before we jump into that, what is real estate? You will see when we go through the slides that the interpretation of real estate for tax purposes could be different from that in common parlance. And when we look at real estate from a VAT perspective, it's essentially any area of land, any building, any structure, or engineering works. So it doesn't necessarily have to be a building or a construction. It could be engineering works which are permanently attached to the land. And this also includes goods which are attached or affixed to the buildings, the structures, or land. If we look at the real estate guide read with the legislation, the tax authority clarifies what sort of assets would qualify as real estate for tax purposes and which wouldn't. So bare land or undeveloped land would qualify as real estate. Buildings permanently attached to the ground, car parking lots, hospitals, all of these are real estate. Whether these are commercial real estates, whether these are residential real estates, we'll look at in the subsequent slides, but they are real estate. If you look at temporary housing that can be moved without damage, or mobile homes, which are caravans, or the shift-based uh, makeshift houses that you have, especially on construction sites, or furniture or equipment that can be moved easily, it's not permanently attached to the property, or goods or machinery that is not permanently attached to a building or property, all of these are not real estate for the purposes of the Oman VAT legislation. Now let's move on to the next slide and look at how transactions in the real estate sector are treated. And here, this slide requires a little more attention because there's different types of treatment proposed for different types of supplies. So supply of commercial real estate is standard rated. What is commercial real estate? Commercial real estate is essentially any real estate that is not used for residential purposes. First sale of residential real estate is standard rated, but the resale of a residential real estate is exempt. What is residential real estate? Essentially, any accommodation that is used for living or dwelling, but it doesn't include the hotels or serviced apartments, and we'll come to that a little later. So, first sale of real estate, standard rated, resale of residential real estate, exempt. Renting of residential real estate is exempt. And when we look at renting, the legislation provides that it will be considered as renting which is exempt only if the real estate is occupied for a continuous period of 3 months or more. And there is an agreement that covers this renting arrangement. In the absence of the two, it won't qualify as renting of residential real estate that is exempt for VAT purposes. And the legislation also clarifies that living out of serviced apartments, hotels, tourist complexes, even if it is for the period of more than 3 months, will not qualify as renting of residential real estate. When we look at supply of bare land or undeveloped land, that is exempt. But again, we'll see in the subsequent slides that undeveloped land has a specific connotation for VAT purposes. And last, supply of real estate, which is located within a designated or a notified special zone in Oman, is zero rated. With that, if we move on to the next slide, let's look at the scope of residential real estate. As I mentioned earlier, it's essentially any accommodation for dwelling purposes. So it includes a residential apartment or a villa, but it does not include a hotel, tourist complex, commercial complex, caravans or mobile homes, or anything that is an unlicensed building but still used for residential dwelling. If we move on to the next slide, we then look at the treatment of specific supplies, starting with bare or undeveloped land. Now, in common parlance, when we say bare or undeveloped land, we'll probably imagine a farmland or a land which does not have a structure on it as bare or undeveloped land. But the VAT legislation does not necessarily see it that way. And that's not just peculiar to Oman, that's generally the position in the GCC and globally. Bare or undeveloped land for VAT purposes is a land without any man-made structures, whether they are completed or partially completed structures. So long as there is a structure that goes through the surface, above the surface of the ground or below the surface of the ground, it will not qualify as a bare land. So any plot of land that has utility constructions, that has a road on it, will not qualify as a bare land. A farmland that has irrigation systems, that again has roads, inroads, will not qualify as a bare land. So to the extent any plot of land has any structure above the surface or below the surface, to the extent that the construction of that breaks the surface, It disqualifies the plot from being a bare or undeveloped land. Now, let's say in an example where a person leases bare land to a lessee, and the lessee then undertakes construction on that land. What happens with the tax treatment? As I said earlier, the transactions in bare land, sale or lease, are exempt. In this example, when the lessor leases the bare land, it is exempt. But as soon as the lessee constructs any structures on it, the status of that land changes to developed land, and from that point on, any consideration that is received for that land should be standard rated. The next is real estate owned by individuals. We've been asked this question several times. Is there an exemption available for any earnings that individuals have from real estate? And the answer is, if it's an economic activity for the individual, there is no separate exemption. When you look at the VAT legislation, it says any person who engages in a particular commercial or economic activity on an ongoing or a regular basis with the intent of generating some income, that is an economic activity in the eyes of the VAT legislation. As soon as any person, natural or legal, undertakes an economic activity and hits the registration threshold, it will be required to register. So whether it's a single person company, whether it's an individual, whether it's a conglomerate or an enterprise, if it has properties and let's say it sells, the individual sells the property and gains, let's say 50,000 Omani Riyals from it, the mandatory registration threshold is 38,500. Now you need to look at whether this supply is exempt. If yes, then perhaps you don't need to register. But if it's standard rated, then you certainly need to register. And this merits more consideration when you're engaged in the renting of commercial properties or sale of developed property firsthand. Mixed use real estate, what does that mean? Any real estate that has areas designated for residential use and commercial use are referred to as mixed use real estate. In these cases, when it's renting of the residential space, obviously it's exempt from VAT. When it's renting of the commercial space, it's subject to VAT. Therefore, it's critical that when businesses deal in mixed use real estate, they apportion the consideration that they receive towards residential dwellings and commercial dwellings. They're able to identify or distinguish these so that they're able to apply appropriate tax treatment. And that's not just for the supplies, because even on the input VAT credit, you're only eligible to recover input VAT that is exclusively used for making taxable supplies. You cannot recover input VAT credit on purchases used for making exempt supplies, and you're only allowed proportionate input VAT credit of supplies of purchases used to make taxable as well as exempt supplies. Car parkings, when we pay car parking charges in a commercial car park, they are standard rated. When we look at car parking that comes with commercial places or residential spaces that we buy or rent, it would depend on whether the car parking is supplied separately or is it supplied along with the original real estate. If it's supplied separately, then it could be standard rated. But if it's a part of the residential property that you're buying or leasing, or the commercial property that you're buying or leasing, the car parking, the treatment of the payment for car park would be the same as the underlying supply. So if it's commercial, it would be standard rated. If you're renting a residential dwelling and the car park comes as a part of it, it would be exempt. Similar treatment for service charges, which is essentially maintenance and utilities. If it's an independent supply, separate consideration is charged for it, then that would be standard rated. But if it's a part and parcel of your rent that you pay for commercial real estate, it would suffer the same tax treatment as the underlying supply, i.e. it would be standard rated. If it's a part of the residential real estate that you rent, it could be exempt. Services provided by non-residents. When a non-resident business that does not have any physical presence over here provides services to a taxable person in Oman, in relation to real estate that is located in Oman, there is a VAT charge, but that VAT has to be paid by the recipient who is registered for VAT purposes in Oman under the reverse charge mechanism. So the non-resident doesn't need to have registration in Oman or incur any compliance obligations in Oman. But when a non-resident supplies real estate related services in relation to a real estate in Oman to a customer in Oman who is not registered for VAT purposes, the non-resident is then obliging itself for registration and then compliance obligations. And in case of non-residents, remember there is no monetary threshold for registration. Even a single supply worth a real would trigger a registration obligation. If we move on to the next slide, we continue with the treatment of certain supplies. Retention payments, which are a commonplace in long-term contracts, especially government contracts, where the contractor agrees with the person who's awarding the contract that a part of the payment, a part of the consideration would be withheld for a certain period of time just to ensure that there's appropriate quality, that milestones are being met, and that retention payment, the payment that is retained, is then given by the person who's appointed the contractor after the lapse of the period, or certain conditions that may be attached to it. So how are retention payments treated for the purposes of Oman VAT? Because the supply is already made, it is only the consideration which is withheld and disbursed at a later point in time. The guide clarifies that VAT on retention payments, especially in case of long-term continuous contracts, is due at the earliest of the date of payment of the retention money, the date specified in the tax invoice for the payment of the retention money, or 12 months from the date of commencement of the supply if the first two events haven't occurred. But I think what merits consideration here is also how does your contract look? Does it say that these supplies are already made, you're entitled for a consideration, only the consideration is delayed, in which case you may have to look at your VAT obligations once the supply is concluded, especially when these are one-time contracts. So contracting, nature of contract is extremely important for you to determine the VAT treatment of retention payments. Then there's treatment of snagging, which is essentially correction of construction defects. If these are undertaken by the original contractor for no additional costs, then the works undertaken or the supplies made will not be subject to VAT because the original consideration is deemed to include this. And when these are supplied for no additional consideration, these shouldn't even qualify as a deemed supply by the developer or the constructor. But if these are undertaken by the original supplier or a third party for additional consideration, VAT would be applicable depending on what the treatment of the original supply is. Now, for the real estate sector, transitional supplies are extremely important because construction contracts span over a longer period of time. You need to see if you have any contracts which were entered into prior to 16th of April 2021, i.e. when VAT was implemented, and stagger past 16th of April 2021. Because if you look at the VAT legislation, it doesn't matter when you've collected the payment. It doesn't matter when you've issued the invoice. Even if both these events have happened before the 16th of April 2021, if the supply happens after the 16th of April, you will be obliged to pay VAT on it. What's equally important is, does your contract allow you to recover the VAT from your customer? Because if your contract does not have a VAT recovery clause, or your prices are inclusive of VAT, or you do not have a change in law clause, then the consideration that you agreed in the contract is deemed to be inclusive of VAT. You cannot charge it from your customer. You will have to pay it out of your pocket unless you reach a different commercial arrangement with your customer. Construction or development costs, when they're used for construction of commercial real estate or new residential real estate which is sold, in both instances, the input tax credit is recoverable to the extent that the sale of the residential real estate is the first sale, because both of them are taxable at a standard rate. Now, transfer of business as a going concern has also been clarified in the guide. And this often is a question when, let's say, a huge property developer wants to carve out a certain section, a line of business. Will that qualify as transfer of business on a going concern basis for VAT purposes? Can that be treated as out of scope? To the extent that it qualifies for a transfer of business as a going concern basis, which means that you are carving out an entire business or a part of a business, assets, liabilities, contracts, employees, to the extent that the transferee is going to continue the activity identical or similar in nature, and to the extent that relevant notifications or documents are filed with the tax authority, even the transfer of part of a property business should qualify as a transfer on a going concern basis, which is outside the scope of VAT. With that, if we can move on to the next section, I'll ask Sumit to pitch in and walk us through procedural reliefs, compliance-related experience, and then the issues for consideration in the real estate sector. Sumit, over to you.
Thank you so much, Ava. So over the last 1 year, the tax authority has extended several procedural reliefs to taxpayers in Oman, especially in relation to VAT compliances. First, if we talk about the VAT return filing and the due date, we know that as per VAT legislation, the due date of VAT return filing and payment of tax is 30th of the month following the end of the tax quarter. There's been no relaxation in the legislation that if the due date falls on a weekend or a holiday, can taxpayer file the return or pay tax the next working day, as they have been doing for income tax in Oman. In the financial service sector guide, the tax authority has clarified that in such event, the taxpayer can file return and pay tax on the next working day. We have seen this happening on the tax portal in the previous quarter, but it was never given in the legislation, so all the taxpayers were following 30th as the last day of filing returns. But in future, we can probably look at this as an extension. On exchange rate, in case any transaction is effected in foreign exchange, the VAT legislation requires the tax amount, when I say tax amount, the VAT amount, to be converted into Omani Riyal using the average buy and sell rate published by the Central Bank of Oman on the date of supply. Now, the Central Bank of Oman, they do publish the rate on a daily basis, but the problem is the publication does not happen at the same time. It can happen any time before 2 p.m. So if a taxpayer has to issue an invoice before the rate is published, what they should do? So in that case, the guide issued by the tax authority for financial services says that if you don't have the exchange rate at the time of issuing invoice, you can refer to the rate which has been published by the CBO for the immediately previous working day. To that, there is some relief to taxpayers so that they don't need to wait on a daily basis for the rate if they have the previous day rate, but still you have to follow the date which is published by the Central Bank of Oman. Moving on, if you go on the tax invoices, the VAT legislation does not prescribe any specific time limit or window to raise a tax invoice once you make the supply, which is peculiar to Oman because if you look at other GCC countries, they generally have a provision which allows taxpayer to raise invoice within 15 days. This would be applicable mostly in case of one-off supplies, when you have to raise invoice within a time period from making the supply, not in case of continuous supply. And I will discuss that separately. But for the time being, there was no provision in the legislation, but the tax authority in the guide has clarified that you can issue an invoice within 15 days from the date of supply, but it should not be beyond those 15 days. On summary tax invoice, the legislation allows the taxpayer to issue a summary tax invoice at the end of every month for all the supplies made during the month. Technically, if you look from the VAT executive regulations, the summary tax invoice is supposed to contain all the particulars as required on a normal tax invoice. But in any taxpayer is facing a challenge in incorporating any of the details which are required generally on a valid tax and on a standard tax invoice, the taxpayer can reach out to tax authority to get a special dispensation in this regard, and that probably will help some of the businesses who are not able to capture everything on their summary tax invoice. On clarifications, unlike in other GCC countries which have specific provision allowing taxpayers reaching out to tax authority to obtain advanced ruling or formal clarifications, the VAT law is silent on this aspect. But taxpayers still, they need to approach the tax authority. We have helped many clients wherein we reached out to tax authority to get a private clarification, and we had a fair share of success in that aspect. But since these clarifications are private in nature, they are deemed as binding only between the tax authority and the taxpayer who reached out to them. On input tax apportionment, the VAT legislation requires a taxpayer to apportion the value of supplies to the extent the procurement is used for taxable supplies. And then they have to do this apportionment at the end of every tax quarter, followed by an annual true up or true down. Again, in the financial service sector guide, and most of these clarifications, if you see, I'm talking about is coming from the financial service sector guide. The tax authority has clarified that subject to satisfaction of certain conditions, a taxpayer can compute input tax apportionment for the first 3 quarters of a tax year based on the ratio which they arrive for the immediately previous financial year. But for the last quarter or the fourth quarter, they need to follow the values or the amounts for the current financial year. While the tax authority does not expect a taxpayer to reach out to them and obtain a specific approval in this regard, but it's always advisable that we notify the tax authority to avoid any surprises during future audit and assessment. On refunds, the tax authority in Oman has been fairly quick when they started processing the refund claims. And we have seen cases where the refund amount, and I'm talking about those cases where the refund claim was robust enough, there were all the necessary documents attached to the refund application. In those cases, the tax authority has credited the refund amount to the bank account of taxpayers as early as 2 to 3 months from the date of filing the refund claim. And now that's fairly quick if you compare with other GCC countries, wherein tax authorities took substantial time in the initial processing of the refund claim. So that's a good move from the Oman tax authority. If you look at the financial service sector guide, in one of the clarification, the tax authority has said that the provision of deemed supply, which is generally applicable in case you make a supply but don't receive any consideration, that provision will not trigger, and therefore there is no requirement to pay VAT in certain situations such as waiver of customer fees, because in banks they generally waive certain fees which they charge to the customer. Now, obviously, since that's a relaxation, it comes with certain conditions, and the conditions are broadly that the fees should be waived for genuine commercial reasons, and it should be to an existing customer. You should not have any specific procurement which are directly related to the waiver of those fees, which basically means that if it's general business, it's general business for the company and they've not incurred any specific expense, they can claim they're not required to pay VAT on those supplies. And finally, on the import VAT deferral, the tax authority has been allowing deferment of VAT, which is payable on import of goods. Instead of paying it upfront in cash at the time of clearance of goods, the taxpayer can report it in at the time of filing the VAT return. Now, this has helped many taxpayers optimize their working capital requirement. And for companies in real estate sector, they may be high value imports on account of equipments or furniture they are importing for the construction purpose. Now, in your case, since the consideration may be deferred at a future date, but you have to pay VAT at the time of import, it makes more sense that we have an import deferral in place so that we don't need to pay VAT upfront and we wait for the consideration to be charged from the customers. But it is important that for obtaining the import deferral, the taxpayer needs to submit a bank guarantee. And it is important that the taxpayer tracks the amount of bank guarantee vis-a-vis the amount of imports they make on a quarter-on-quarter basis. because we don't want to get into a situation where we import more than the value of bank guarantee, which could lead to situation of import not being cleared by the customs authority, leading to demurrage charges as well as payment of VAT in cash in such extreme situations. Moving on to the next slide on our experience of compliances over the maiden year of VAT implementation in Oman. From a written perspective, unlike other GCC countries, Oman requires a taxpayer to report details of purchase and sale of capital assets, as well as purchase from unregistered dealer in Oman, which are outside the scope of VAT. This is generally capture these transactions in the return or in their IT system, which eventually leads to a non-reporting or incorrect reporting in the VAT return. It is therefore important that in our ERPs, we have separate identifier or tax codes to identify such purchase and sale. In case of import of services, the VAT legislation requires a taxpayer to put a note on the invoice received from the overseas vendor, which should provide the VAT amount payable under a reversal mechanism. In our experience, it is not uncommon that many businesses have missed out this requirement, which technically is a procedural non-compliance. On import of goods, as I said, this could be significant for many of our the businesses in real estate sector. It is important that the bayan documents or custom documents which are filed for import clearance, they should be in the name of the business. Because unless you are the importer on record and you are the owner of goods at the time of import of goods into Oman, the tax authority will not allow you an input credit of VAT which you pay on import of goods. And it becomes equally important when you are engaging a third party to clear goods on your behalf. On ineligible credits and documents, the Oman VAT legislation allows a 3-year window to claim input credit, which you have input credit of VAT, which you have paid against any invoice to the vendor. Now, this is an extended time period. If you look at other GCC countries, we generally allow input tax credit to be claimed in the same tax period or the subsequent tax period. So why this helps us is because if you have a doubt on whether you should be claiming credit or the credit is eligible to you, or you have a sufficient document in place to substantiate the credit, it's better to park the credit and claim it in subsequent returns because you have an extended period of 3 years and it won't be a cost to you unless until you are able to claim it in the next 3-year returns. In case of nominal value supplies, the VAT legislation allows a taxpayer to issue a simplified tax invoice, which has some few particulars as required for a normal tax invoice. The VAT legislation does not have a specific provision which disallow or restrict the buyer of goods or service against a simplified tax invoice to claim input credit of VAT they pay on that simplified tax invoice. But based on our discussion with the tax authority, there could be possibility that input tax credit claim on simplified tax invoice because the invoice may not have the name of the company or the business and the VAT number of the business, they disallow the input tax claim. On foreign exchange, as I discussed in the previous slide, the foreign exchange has to be considered as per the rate published by the CBO. We don't have, the law does not allow a window or relaxation to use the rate as may be published by an external sources, but that's what we have to follow. Separately and relatively, if you are maintaining books in a foreign currency, say US dollar, which is other than Omani riyal, the legislation requires the business to apply to the tax authority and get an approval in this regard so that you can maintain books in foreign currency. On employer-employee transactions, taxpayer needs to evaluate VAT implications on various transactions, whether it's on account of allowances, whether it is on account of benefits, or whether it's on account of gifts, accommodation, which they are extending to employees, because employer and employee are treated as related person for VAT, and therefore we have seen many cases where clients or businesses miss making necessary VAT obligations or reporting VAT on such transactions. I'll move on to the other section On other VAT compliance related aspect, where a supplier is making a supply and that supply is eligible for zero rating, for example, supplied to customer in special zone, in that case, the tax authority in the guides have clarified that if you are charging a VAT of 0% as a supplier, you should ask for a declaration from the customer to satisfy the conditions of zero rating on those supply. So as a supplier, it is necessary for you to get a declaration from the customer. And on top of the declaration, if you add an indemnity clause on those declaration, it will only help us it will only help with recourse in case of any future dispute on the tax position which we today adopt. On responsible person, the tax authority is now allowing non-resident businesses to be registered for VAT purpose without the need of appointing a local responsible person, which was the requirement of VAT legislation. They can do so upon submission of a bank guarantee. But more importantly, every taxpayer or responsible person is obliged to notify the tax authority in case they are not in Oman for a period of more than 90 days in a tax year. We generally miss this such requirement, or we probably don't track whether the responsible person is in Oman for such period or not. But that's a requirement as per the VAT legislation, not just on the company, but also on the person appointed as responsible person. With that, moving on to the next slide on the components of compliance. There are several aspects for an effective and efficient compliance process, but I will say that most of these generally aim to support the four pillars of compliance. First, data completeness, uh, which includes aspects such as whether your data is complete. Uh, have you considered all the transactions effected, whether within the ERP or outside the ERP, say manual transactions? Have you considered all the relevant tax codes which have been configured in the ERP at the time of VAT implementation? This will basically ensure that you don't miss out reporting any transactions in the VAT return. Second, data correctness. Is the data correct? Is it mathematically accurate? Do we have a process to reconcile the data which you report in the return with the underlying files? Third, tax technical. Do the transaction or data set looks right from a tax technical perspective? Are they in alignment with the business in general? And last but not the least, governance, which includes aspects such as do you have sufficient audit trail of the changes which you make to the original working files? Do you have a maker-checker concept to review the returns before they are finally submitted to the tax portal? To achieve all of these, we as KPMG follow a consistent technology-enabled process for the VAT compliance. As part of this, we have process depending on whether the data which you have is in a structured form or an unstructured form. If the data is in structured form, like in SAP and Oracles of the world, the standard tax report available in ERPs can be used to run certain validation checks on the data and come out with the errors and issue log, which can be shared with the clients. If the data is in unstructured form, we have standard templates in place which can be used again for running the validation checks. All of these can be automated through a system, and once the manual adjustments are made on account of any errors or issues identified in the data, this return can be auto-populated. And on top of this, we have dashboard functionality, which gives us a trend analysis of returns filed for this quarter compared to previous quarters, and other aspects such as reconciliation reports, audit trail to identify the changes made from the original data set. With this, we aim to automate the compliance process and achieve minimal human intervention. We now move on to the next slide on key issues for consideration for this sector. As Ava has mentioned in her presentation that various topics have been discussed in the VAT guide, which was issued for real estate sector or some other sectors, but still there are some points which are open for debate. First, VAT due date in case of continuous supply of service. In case of continuous supply of service, as per the VAT legislation, the VAT is generally due on the date of payment specified on the invoice or the date of actual payment. There is no reference of the date of invoice in the provision of the law, which I want to quote as Article 27 of the law uh, in the Oman VAT legislation, which is different from other GCC countries, which says that if you issue a date of invoice, in case of continuous supply of service, the date of invoice is also an important aspect. There is a separate provision which says that if you issue an invoice uh, with a tax amount thereon, the VAT due date is as per the date of invoice. But this is not relevant, or this is not applicable only for continuous supply of service as per the wordings of law. So what should a business do in case of continuous supply of service? Should they just rely on the date of payment or actual payment which they receive from the customer? Second, VAT due date in case of a time lag between the transfer position and transfer title. There may be a situation where you transfer the position of the real estate to the buyer, but but it takes time in transfer of the title. So when should I pay tax? At the time of transfer position or when the title or lease deed is registered with the ministry? Third, alternate method for input tax apportionment. The VAT legislation in Oman, as I discussed in previous slides, requires you to apportion input tax credit on account of exempt supplies. While the legislation has a provision which allows a taxpayer to use a different method than the one prescribed in the legislation, but it don't give you different kind of or different methods which you can choose from. Unlike I would say in UAE, which have listed certain methods which can be followed. One of the method for real estate is say floor space method, wherein you distribute input tax credit based on the floor space for between residential, which is exempt from VAT, and commercial, which is subject to VAT. But in the absence of clarity or guide from the Oman Tax Authority, it may become challenging for taxpayers to identify which method they should follow and which method is more beneficial for them because each business is different. Fourth, VAT on advances received before the effective date. Because these real estate transactions are generally long term, you would have received some advances before the VAT was introduced on 16th of April 2021, or before you were registered for VAT purpose. Now the question is the advances which you have received before the VAT effective date, when is VAT due on those advances? And the answer may also differ depending on whether the advance which you have received is for a long-term contract or a one-off contract. Because in case of long-term contract, you may be supplying services over a period of time, and to the extent you supply service, you will be adjusting the advances which you received as on the effective date. So which day you should pay VAT, because if you delay in payment of VAT, there will be an additional tax or interest implication in the hands of business. And last, VAT treatment of rent-free period, which basically means that if a landlord gives you an offer that if you stay for 12 months, you pay for 11 months and 1 month is free. I'm talking about commercial rental because residential property is anyways exempt from renting purpose. But in those situations, whether you are supposed to pay VAT on rent for 12 months or for 11 months for which you receive the consideration. Generally speaking, these are considered as a conditional supply, which basically means that if you stay for 11 months, then you get 1 month free, which means the VAT liability should come only on the total amount which has been received as consideration for 11 months period, and not an extra, or not VAT, and not to pay VAT on an additional month for which the landlord has not received any consideration. With this, I want to hand over the presentation back to Abba to discuss the key next steps.
Thanks, Sumit. So if you move to the next slide, now having looked at the different tax treatments that exist in the real estate sector, if you are a supplier or if you're a recipient, you need to examine a few things in light of the guide. And if there are any revisions required, either to tax positions or to the returns, you need to course correct, especially course correct before the tax authority can initiate audits. So mission critical items for businesses: examine if supplies are eligible for benefits or exemptions. If they are, have you satisfied the conditions? If you have exemptions, have you recovered your input tax correctly, or have you foregone your input tax correctly? Evaluate when is the tax due, especially in case of long-term contracts. Have you received advances in which you should have paid VAT in the first quarter, or when you have continuous supplies, are you monitoring the date of supply? Evaluate the treatment based on the nature and the use of the underlying property. And you also need to look at incidental or ancillary charges properly. Revisit the positions based on the guide. If the guide does not clarify a certain position, seek clarification from the tax authority depending on the materiality of the transaction. Wherever it requires a revision of documentation, go through the contracts, purchase orders. If there's VAT clauses that need to be built into the contract, you need to do them now. And you also need to look at what the retrospective effect is. If systems need to be updated, customer master, vendor master, tax codes, you need to do these vendor management systems. You need to make these changes so that the accounting is in line with the VAT positions, is in line with the documentation. And communicate with internal as well as external stakeholders. If there are any changes, you need to keep the internal stakeholders abreast. If you intend to recover any additional charges from customers, you need to keep the external stakeholders aware. And in that, if you need any clarifications from the tax authority, that's an external stakeholder for you too. And in our experience, we've seen a lot of non-compliances occur because of lapses by users. Those users could be people who are accounting for treatments. Those users could be people who are in sales, contracting. So it's important that you have user trainings on an ongoing basis to make sure that they're abreast with the changes and the requirements of law. And if there's a cost correction required and a revision of returns required, do it at the earliest on a voluntary basis, because the penalties are eye-watering, and the audits and assessments are just around the corner. With that, we'll wrap up the presentation for today, and we will request Stuart to come back on for the Q&A.
No, thank you, Abba, Sumit, and Mohammed. We've got a few questions coming in through various means, so let me just bring those up, and I'll direct those questions. So, Abba, while you're on, maybe the first question for you, and this is a little bit long, so apologies. Let me read this to you. An individual is registered for VAT as his commercial tenants are more than 38,500 Omani Real, and now he is renovating one building in which he said he can use it either commercial or residential or both. So as he is renovating, he's having expenses which he's paying VAT, such as elevators, contractors, ACs, example. So can the individual claim his or her input VAT, even if the individual is not sure how he or she will use that property and for which purpose, as it will take a year?
I think given the uncertainty on the use of the property in the future, and the fact that the Oman VAT legislation allows a taxpayer up to 3 years to recover input VAT credit, our recommendation would be certainly to err on the side of caution, park the credits. You know in due course, because you will have to register the property at some point in time. You will have to designate a use to it. When you do that, you can recover input VAT credit. Because if you recover the input VAT credit today, and let's say in the future you applied for exempt supplies, that means you've excess claimed input tax credit. You used it to set off VAT liabilities, which means you short paid your VAT liability, which then translates into additional taxes, which then translates into administrative penalties. So the short answer is wait. Once you know, claim.
No, thanks, Abba. Is there a time period if you change the use post completion?
Is there a time period if you change the use post completion? No, there isn't a time period which is prescribed in the legislation or suggested in the guide, at least.
Okay. So one maybe question for you. If there's a management company between the owner and tenants, how would the VAT impact take place in terms of the VAT invoice transaction? Who has to register? The owner of the management company, and on what grounds?
Thanks, Stuart. So in the VAT legislation, there's a concept of disclosed agent and undisclosed agent. So if that management company is acting as a disclosed agent on behalf of the owner and they are collecting rent on behalf of the tenant, they are basically acting on behalf of the owner. And it is the owner responsibility, depending on the nature of the property, to pay VAT on the fee or the consideration they recover from the tenant. But separately, the management company or the agent who is providing the management services to that owner need to consider their VAT implications on these charges they recover from the owner.
Excellent. Mohammed, the question here asking, are there any thresholds for individuals to charge VAT on commercial rental income?
Yes. So as Abha mentioned during her presentation, there's no separate treatment for individuals. So if the individuals is giving any commercial premise on rent and the total income earned during year exceeds the mandatory threshold of over 38,500 Omani Riyal, such individual has to register with the tax authority and pay VAT.
Thanks, Mohammed. There's a question here just around the transition period. So individuals buying a residential house before 16th of April 21, they paid 70% of the payment on that date, before that date, and they pay the balance after April 21. Will the individual have to pay 5% on the 30% or on 100% of the payment for the house? And then there's a following question. There was a contract between them which stated that if there was any VAT in the future, it will be applicable. So just the question is around how do you treat VAT in this transitional period, Abba?
Got it. So since the contract already has a VAT recovery clause, means that the developer has the right to recover additional VAT as may be applicable from the customer. Now, coming back to the first question on what portion will the VAT apply on, what the customer wants to look at or the purchaser wants to look at is 70% may have been paid as an advance prior to 16th of April 2021. But what were the milestones and what was the completion of the milestones? So, for example, if we say out of the 100%, 30% was towards works undertaken and completed prior to 16th of April 2021, then that portion of consideration is outside the scope of VAT. Everything after, which in this example is 70%, would be subject to VAT. So when the payment was made will not matter. Look at the milestones, look at the completion. Whatever work is completed after the 16th of April 2021, that's where your developer should be charging you a VAT.
Thanks, Sada. Makes sense. So just a question around the VAT treatment in respect of the lease of bare land, where the consideration is received in advance.
Sumit, do you want to take that one?
Yeah. So Stuart, in case of bare land, we discussed that the VAT is exempt from tax. So there's no VAT. So whether you receive the payment in advance or you receive payment upon raising of the invoice, there's no implication. And at the end of the day, the VAT is exempt on bare land.
Okay.
Well, just to add to what Sumit said, let's say if that is the only transaction that the supplier is dealing in, that means the supplier may not even have a registration obligation.
Yeah.
But if the supplier has taxable as well as exempt supplies and has received an advance on the bare land, part of which also relates to post-implementation of VAT, then when you're looking at the input tax apportionment calculation and you're looking at the exempt income, you will need to look at that portion of the advance that relates to the period after 16th of April in calculating what input tax credit is recoverable for the business and what input tax credit isn't.
Thanks, Sabah. Actually, while you're here, there's another question similar to the first one, just around the distinction between residential and commercial. And the question relates to where there's a guest house charged by a company to an employee of another company on a temporary basis, say less than 3 months. How would you treat that?
So if it's a guest house where someone's staying for a period of less than 3 months, while it is used for the purpose of housing people, dwelling people, it's still a commercial establishment. And to that extent, the transaction will qualify as a commercial supply of commercial property, not a residential property, and would be standard rated.
Yeah. I realise we're gone past the hour. There's just a couple more questions that have just come in. Let me just put those to the panelists. They should only take another 5 or so minutes. One here was around apportionment of common expenses related to a common property. Do you do that based on the supply numbers reported in the VAT return or based on the accrued accounting numbers?
So, Stuart, in case of apportionment, we look at the numbers which are actual on quarter-on-quarter basis, which eventually we report in the VAT return. That's a general apportionment method which is applicable as per the VAT legislation. During the presentation, we discussed that the tax authority has allowed taxpayer to use the ratio, which means the figures of the previous financial year for the first 3 quarters. So it should not be an accrued numbers. It should be an actual numbers based on which you are paying VAT in the VAT returns as well.
Okay. VAT on water and electricity charges paid by a tenant can be claimed as input VAT based on the rental agreement. I think that's a question. Is that correct or incorrect?
So generally, yeah, this has been a question from input claim perspective. What happens that there is one master, I will say, meter for electricity and water, and then there are sub-meters. If those sub-meters are in the name of the tenant, and then you are getting electricity bill or water bill in the name of that sub-meter, which if would be in the name of the tenant, in that case, whatever VAT you pay should be available as credit. And I assume this is for commercial property, not for residential property. Second, if there are no submeters and it is not in the name of the tenant, in that case, for tenant to claim credit based on an invoice raised for the master meter, which is in the name of landlord, would be difficult. So it's important to ensure that we have submeters in the name of the tenant, and we have seen that electricity company and water company are allowing the tenants or the landlords to update the details of the submeters, and it can be done online as well. So should not be concerned from a procedural perspective if you want to claim the credit.
Okay. One more assistance, you just come in now, Amber and team, and so again, it's around timing, and the question is where the construction starts later. However, at the time of the receipt of the advance, people are not aware of the time when the construction will take place. So should that be treated exempt or taxable?
Right, like I said, sorry, Sumit, you can take that one.
No, sorry, I didn't get that properly. So I was asking what I just wanted to get a question clearly.
I can take the question in that case. So goes
Sorry,
back
my accent, Sumit, preview, apologies.
So I'll go back to what I said earlier. If you receive advances or if you if you receive advances and you're not aware at the time of the construction whether it's going to be taxable or exempt, it's a little. We wouldn't recommend that you exempt the entire supply, because that means that if subsequently you decide to make a taxable supply out of it, you've pushed back the date on which VAT should have been paid, and you're exposing yourself not just to VAT but additional taxes and penalties. So I'm sure at some stage of the construction you will need to register the property, because that's a requirement under the legislation, and you would know the use. If the amounts involved are material, then you perhaps want to consult with the tax authority and refer these cases to them and have their view on how they would want to treat these transactions.
Okay, no, thank you, Ava. Look, I think that's the questions I've got in front of me. Apologies, I think we've got through them all. If for some reason we have missed a question, please get in contact with us. Apologies, we've gone a little bit over time, but hopefully you found the session informative and worth your while. As I said, there is a feedback form, and we'd love you to just take a minute just to fill out that feedback form when you log off. But thank you for joining, and enjoy the rest of your day. Thank you.
Thank you, everyone.
Thank
Have a
you,
good
everyone.
weekend. Take care.
Thank you, everyone. Have a good weekend.